Hello there. Our conversation today is about investing in real estate in India. It's an exciting opportunity that has caught the attention of many international investors. So here I am to guide you through the ins and outs of this market. So let's dive right in and let me talk you through the 8 critical aspects of investing in real estate in India. Have you ever wondered about the types of properties you can buy in India? It's an essential starting point. So question number 1, what types of properties can you purchase as an investor in India? Now let's talk about the second key point, how to fund your real estate purchase in India. Documentation can be a bit of a maze, right? Question number 3, what are the documentation requirements when buying real estate in India? Number 4, have you heard about the power of attorney concept in real estate? We will unravel its significance today. Taxes, a topic that's always on our minds. Are you aware of the taxation issues that can come into play when investing in real estate in India? That's our question number 5. The return on investment, a big factor for any investor. Question number 6. What can you expect in terms of investment return when you invest in real estate in India? Repatriation of funds, a term that might sound complex but is crucial for international investors. So question number 7. What rules govern the repatriation of funds in India? Question number 8. What precautions should you take when investing in real estate in India to ensure your investment is secure? Let's start with some important details about acquiring properties in India as an NRI under the Foreign Exchange Management Act or FEMA. Here's a question. Did you know that under FEMA, NRIs have blanket permission to acquire properties in India? Quite convenient, isn't it? But there's a catch. Do you know what types of properties are covered under this permission and what's not allowed? Let's explore that. Okay, so here's an interesting fact. NRIs can acquire any number of properties in India and there is no restriction on the number of properties you can own. Now, isn't that good to know? Do you have to report or inform the RBI about your property purchase as an NRI? Well, the answer may surprise you. You don't have to take permission or inform RBI about property transactions. As an NRI, there are 3 different ways you can acquire properties and the rules differ slightly in each case. Have you ever thought about how you can acquire properties in India? Allow us to break it down for you. Did you know that when it comes to inheritance or gifts, you can receive any type of properties from relatives, including agricultural land and farmhouses? If you've acquired a property as a resident before moving out of India, you can continue to hold it without any legal issues. When purchasing property as an NRI, there is something crucial to remember. Can you buy any property? Yes, all types of property except agricultural land, farmhouse and plantations. Lastly, before you take the plunge into property investment in India, you should consider some important factors. Have you thought about the location of the property, the type of property you want to purchase, and the prospects of rentals and capital appreciation, etc. Now let's talk about the financial side of buying property in India. It's not just about choosing the right property, it's also about how you can fund it. Do you know how you should pay for property in India as an NRI? The purchase price must be in Indian rupees, but how can you route it through banking channels? Have you ever thought about using traveler's checks or foreign currency to cover the cost of the property? Well, here's a hint. You might want to reconsider that. They are not an accepted mode of payment for real estate purchase transactions. So you're ready to buy property in India, but where will the funds come from? There are 3 options available to you. If you've accumulated enough savings during your working life in India, the balance from your NRE or NRO account can be used to meet the cost of the property. It's a practical approach, isn't it? Are you currently working abroad and saving your money in overseas account? You can remit these funds to your NRE or NRO account and use them to fund the property. That's also a good way to make your overseas earnings work for you. But what if you don't have the funds to pay for the property upfront? No worries, you can explore the option of a home loan from banks or financial institutions in India. The loan is subject to certain conditions that you need to keep in mind. The documentation differs according to the country of your residence. As per RBI directive, the maximum loan would be 80% of the value of the property and the balance needs to be funded by your own sources, which should be available in the account at the time of availing the loan. Keep in mind that the loan amount cannot be credited to your account, but it will be remitted to the seller's or developer's bank account against your authorization. The loan repayment must be through inward remittance to your NRE or NRO account with necessary ECS or post-dated checks for the EMI payments. But what if your property is rented out? Then you can use the monthly rentals to meet your EMI payments. The documentation process when buying property in India, whether you're a resident or a non-resident, is an important aspect to consider. But for non-resident buyers, there are some additional documents you should be aware of. Let's take a closer look at this. Do you know what title deeds are and why they're crucial when buying property here in India? It's essential to confirm the ownership of the person selling the property. You'll need a complete set of title deeds that confirm the ownership of the seller. But did you know that there are also additional documents like partition deeds and gift deeds that can come into play? Tax payment receipts are also essential to confirm that the property's taxes are up to date. And speaking of ownership, local government land and property records also play a vital role in confirming that. But there's more to it. You'll also need an encumbrance certificate. EC clarifies or confirms that there are no mortgages or claims against the property. When buying a property, you'd want to make sure it's all legal and compliant. That's where approved building plans and occupancy certificates, famously called as OCs, come into play. A letter of allotment, especially in the case of flats or houses, is an essential piece of this puzzle. There are other types of documents like water and sewerage charges, tax receipts and electricity bill payment receipts, which confirm ownership and ensure there are no dues. Sometimes there might be a loan associated with the property as well. In such cases, a no due certificate from the bank or financial institution would serve as an essential document required. If you're considering buying an apartment, you might need a no objection letter from the resident association as well. Did you know that the cost of this letter needs to be borne by the seller? Legal opinion is a must to ensure that the seller has a clear title to the property. Here's a tip. You should get this from your own legal advisor and not rely solely on the opinion given by the seller or broker. Once you've gone through all the necessary checks, you'll need a properly worded sale deed for the property transfer in your name. This should be approved or corrected by your legal advisor. It's a crucial step in the process. Now let's talk about some identification and financial documents you'll need. Do you have your PAN card ready? It's a must for any financial transaction in India. Your passport is another essential document. It confirms your current location as NRI. If you have an OCI or PIO card, it's important to have those handy as well. These cards confirm your residential status. Are you planning to avail a bank loan for your property purchase? Here's a question for you. What additional documents might you need for the loan application? The requirements can vary from bank to bank, but here's a general list to give you an idea. Complete passport and work visa copy, overseas employment letter or contract copy, salary slip and the bank account statement for at least 6 months, overseas address proof, home lease agreement, utility bill, etc. Statement of your NRE NRO account for 6 months. There you have it. Keep all these documents ready. You are just one step closer to completing the real estate transaction. Now on to an important aspect that can make your property purchase in India much more manageable, especially when you're living abroad. I'm talking about the concept of power of attorney. It's a game changer in simplifying the entire process. Have you ever considered how a power of attorney can help you navigate the completion documentation and other formalities, especially when you cannot be physically present in India? It can make a world of difference. A power of attorney allows you to execute authority in favor of an Indian relative or resident to act on your behalf. But have you thought about the different types of power of attorney and which one is best suited for your needs? There are 3 types of POAs: general, specific and durable. But which one would be the right choice for your property purchase? Let's break it down. General power of attorney is quite versatile as it gives the holder broad powers to act on your behalf without any restrictions. Now what about specific power of attorney? It's a more focused document granting the holder specific or limited power to act on your behalf for a particular transaction. And last but not the least, there's durable power of attorney. This one is intriguing because it gives the holder lifetime powers to act on your behalf without any restrictions whatsoever. You should carefully identify a reliable person as POA holder and execute a specific power of attorney for the purpose of purchase and or leasing of the property in due course. Here's a practical tip. The power of attorney executed abroad for property purchase in India does not require Indian stamp paper. Did you know that it can be executed in plain paper in duplicate and attested by the embassy or consular officer? It's quite a straightforward process. What's next? The original POA duly signed by you and witness should be sent to India, where it needs to be adjudicated in the local sub-registrar's office. Legally, the POA can be adjudicated anywhere in India for a property purchase transaction. However, to avoid any last-minute hiccups, it is recommended to adjudicate the POA in the same registrar's office where the property would be registered. So there you have it. We've explored how the concept of power of attorney can make your life as an NRI property buyer much simpler. Moving on to a rather important topic when it comes to property transactions: taxation. As an NRI, you're liable to pay taxes on your income in India. Interestingly, you can also get deductions and exemptions just like resident Indians. Here's a question for you. Are you aware of the various taxation issues you might encounter when buying, holding and selling properties in India? Let us explore all of this in detail. First things first. When you buy a property in India, you'll need to pay the stamp duty and registration fees as applicable in the state where the property is located. But that's just the beginning. Did you know that there's something called TDS on the purchase of property? As per the Finance Bill 2013, when the sale value of the property exceeds 50 lakh rupees, the purchaser is required to deduct 1% of the sale consideration as TDS and remit it to the government's account through authorized bank branches. Now here's an interesting twist. If you're buying property from an Indian resident, you must deduct TDS of 1% on the purchase value. But what happens if you're buying from a non-resident? Well, if you're buying from a non-resident, TDS is deductible regardless of the sale value. The rate of TDS varies from 20.8% to 31.2% depending on the holding period of the property. Plus a surcharge of 10% to 15% applies if the property value is more than 50 lakhs. In both cases, the TDS amount should be remitted to the government's account, and you'll need to download and provide the necessary TDS certificate to the seller. After the property purchase, you'll also be liable to pay annual property tax to the local government, corporation or municipality. And just so you know, commercial properties typically attract higher tax rates compared to residential properties. Renting out your property? Keep in mind that your rental income is taxable in India and the tenant must deduct TDS of 31.2% on the rent before remitting the balance to your account. Here's the good news. You can submit your income tax return annually, claiming available deductions like standard deduction, property tax payment, and interest on home loan. If you've had excess TDS deducted, you can seek a refund if you're eligible. But there's one more thing you should be aware of. When you contemplate selling the property, you will be liable to pay tax on your capital gains. This depends on the property's value and the holding period. If you sell the property after 2 years of purchase, that's classified as long-term capital gain and the TDS is 20%. If you sell within 2 years, it's classified as short-term and TDS of 30% applies. Plus there's a 4% cess on TDS and a surcharge of 10 to 15% if the property value is more than 50 lakh rupees. Now here's a valuable tip for you. If you're concerned about the TDS deducted when selling property, you can apply for a lower deduction of tax certificate in Form 13. By doing this well in advance, you can either save the TDS deducted or seek a refund of excess TDS when you submit your income tax return for the year. It's a smart way to manage your taxes. Plus, here's some more good news. India has signed a double taxation avoidance agreement or DTAA with over 90 countries. What does that mean for you? Well, it means you won't be taxed again in the country where you're residing. Your chartered accountant will be able to provide professional advice and make sure that you do not face double taxation. So there it is. We've discussed how to save on TDS and avoid double taxation with the help of DTAA. Now let's discuss the reasons why you might consider purchasing property here in India. Many NRIs choose to invest for either economic or emotional reasons. Your objective could be to earn a regular income through rentals, make a profit from the property's appreciation in price, or even plan for your retirement in India. Whatever your motivation, the underlying goal is often to achieve a decent yield from your investment. Property rentals in India have been on the rise consistently thanks to the rapid growth in the industrial as well as service sectors. The increasing demand for residential and even office spaces in many cities suggests the potential for higher real estate prices, rentals, and overall yield from the property. Here's an important aspect to consider when investing in real estate. You should explore your options carefully. Depending on the location and type of property, you can expect different returns. For instance, residential properties typically have a yield of around 2 to 3%, while commercial properties can offer a better return compared to residential properties. Location matters significantly when it comes to rentals and property appreciation. You could consider opportunities that are emerging out of Tier 2 cities. The Indian government has been eager to encourage foreign investment in the real estate space. As an incentive, builders often provide exclusive deals for NRIs, which can be a unique selling proposition for them. In the long run, your property investment here in India is expected to yield better returns compared to what you could achieve in your country of residence. It's a compelling reason to consider investing in the Indian real estate market. Now let's delve into the crucial topic of repatriation of funds, which becomes important when you plan to dispose of your property and possibly settle down somewhere or for any other reasons. Here's what you need to know. If you have a property that you want to sell and repatriate the funds, there are different rules depending on the circumstances. Let's break it down. First, let's talk about the sale of inherited or gifted property other than agricultural land. After the applicable TDS, the proceeds from the sale are typically credited to your NRO account by default. But what about repatriation? You can repatriate the funds from your NRO account up to $1 million per financial year, subject to submitting documentary evidence of inheritance and other necessary documents for remittance purposes, including Form 15CA and 15CB. Now, what if the property was inherited from a person residing overseas? In that case, specific permission from RBI is required for repatriation. Now let's talk about the sale of property that you purchased when you were a resident Indian. After TDS, the sale proceeds must be credited to your NRO account. You can repatriate up to $1 million per financial year from your NRO account, provided you submit the required documentary evidence of inheritance and other documents for remittance, including Form 15CA and 15CB. However, there's a catch. You can repatriate the sale proceeds only if you have held the property for more than 10 years. If not, the sale proceeds will have to be retained in your NRO account until you complete 10 years of ownership. You can also repatriate the sale proceeds of only 2 houses and no more. Regarding the sale of property that you bought as an NRI, the rules differ based on how you finance the property purchase. If you bought the property using the funds in your NRO account, whether it was a loan from a bank or from your relatives, the repatriation rules are the same as those mentioned in the previous scenario. If you took a loan from an overseas bank to buy the property, you can repatriate funds up to the amount remitted through your NRE account or directly through banking channels for the purchase. If you bought the property using funds from your NRE or FCNR account, the repatriation will be limited to the foreign currency equivalent of the amount paid for the property purchase. It's important to note that the capital gains shall remain in your NRO account and can be repatriated subject to the limit of $1 million after complying with other conditions. Repatriation is allowed for up to 2 residential properties only, although there is no restriction on the sale of commercial properties. Here's a final point to remember. You cannot repatriate the sale proceeds from the sale of agricultural property. Let's wrap up our discussion on property matters for NRIs with some important considerations and advice. If you're an NRI from Pakistan, Bangladesh, Sri Lanka or China, keep in mind that repatriation can only be done after RBI approval. When you're dealing with inherited property, you might have to submit an undertaking and a certificate from a chartered accountant to confirm the inheritance as prescribed by the RBI and the Central Board of Direct Taxes. Here's a practical tip. Always keep the property in good shape with regular maintenance. You can engage an appropriate agency to handle this, which helps you avoid any unexpected expenditures caused by tenant neglect. Be diligent about payments like property tax, water charges, association fees, and other applicable expenses. This ensures you won't encounter any last-minute issues. And lastly, a word of caution. In the real estate space, it's essential to stay away from unscrupulous promoters and crafty brokers who might lure you with attractive proposals. Such properties could become problematic due to legal and other issues. Always seek professional help to make informed decisions and safeguard your investments. Investing in property here in India can indeed be a fantastic option for diversifying your portfolio and earning decent returns in your overall wealth building journey. However, it's absolutely imperative that you thoroughly understand the legal framework, local market conditions, and the potential for property value appreciation. Being well informed about all of these aspects and more is an essential guide to navigating the complexities of property investment and avoid potential pitfalls. By doing so, you can position yourself to achieve the expected returns from your investment. Thank you so much for joining us today, and we hope this information has been valuable to you. Wishing you the very best in your property investment endeavors as an NRI.